Welcome you all to the Daily Energy Markets podcast. I'm delighted to be joined post-summer again by Rustin Edwards, Head of Sales and Marketing at VKG, David Fife, Chief Economist at Argus Media, and Bora Bariman, Managing Partner at Hormuz Straits Partnership. Great to have you with us, gentlemen, this morning. Let's get a catch-up from your perspective on what these oil markets have been doing, and more importantly, what the trajectory is really for the fourth quarter now as we come to the end of it. David, can we start with you in terms of oil price trajectory, stability? We've seen a range recently which looks quite comfortable, being pinned in by the usual factors, bearish, bullish factors. Where do you see that going in the fourth quarter, and why, if you see any movement at all?
Okay, well, good morning, everyone. It's great to be with you. I think to a certain extent, we've had a bit of surprise in the market that there hasn't been a softening in prices before now. We've had the tariffs issue, which is obviously acting as a drag on economic activity levels and investment and consumer spending. Um, and at the same time, we have, at least on paper, had the specter of OPEC Plus raising supply by an excess of 2 million barrels per day. I think the two sort of offsets for that are, one is that overall levels of merchandise trade have actually remained relatively resilient compared to expectations back in the spring. So we've yet to see a major dial down in economic growth, although clearly the Fed today will address what is a slightly troubling trend in US jobs. At the same time, we've had actually net incremental supply to the market from OPEC Plus has been down between March and August. So the oversupply has not materialized in the market. I think we will begin to see a bit of a surplus emerging in the fourth quarter, partly because Middle Eastern summer demand of direct crude burn will be diminishing.
Yeah.
So exports, in theory, should nudge higher in the fourth quarter. And then we're really going to be looking at the macro situation. And I think it's only now that we're really beginning to feel the impact of the tariffs on economic growth and therefore potentially oil demand. So I think looking forward, the risk is that we start to see surplus feeding through, and that would tend to weigh on the front of the curve and on prompt prices.
Okay, yeah. I mean, as you said, so far, from a corporate point of view, from even a trade point of view, we've seen hesitancy and nervousness, but hasn't trickled through yet to economic performance. The US, as you said, the jobs figures looked a bit worrying this month, and we've got another update coming today. Bora, let me go to you there with that. Oil prices relatively okay so far because of these factors that David just mentioned. Another one that he didn't mention, but it's obviously there, is Chinese demand. Chinese stocking up a lot, stockpiling. That has been a big support, according to market watchers. Bora, do you agree with that? And from your perspective, looking east, if you like, east of Suez, do you think we can rely on that support going forward as these trade tariff impact probably starts to hit different economies much more?
Can't say too much about the oil market dynamics and oil price dynamics. Clearly, uh, oil is being supported by the overall relative devaluation of the dollar, and talk of alternatives to the dollar. Clearly, they will have an impact on currency flows and the denominator in which oil is measured. I'm overall more confident about the direction and what we can expect from East Asian demand than I am about US and European demand. Um,
I mean,
I think
oil and
I
the
think the
US
focus should be
dollar,
on
that
dollar.
correlation between oil and the dollar, though, is being put into question. There's definitely a correlation between gold and the dollar, maybe more gold being bought as, the people are questioning whether actually, though, that correlation is as tight as it used to be, with so many sort of other macro factors really upside
Exactly.
down. Yeah.
We're talking about barter, right? Bartering dollars for oil, bartering euros for oil, yuan for oil. But the world is increasingly focused on building their gold reserves. And you can see that the outlook for oil is not fantastic when you denominate it in gold. Clearly, there is a leakage of value out of oil in gold terms. And this is reflecting a shift in demand. Clearly, there's a secular shift in demand that's remaking all aspects of the market as we go into the energy transition. I think energy transition is a big part of it when we're looking at Asia, and when we're looking at Europe and the United States, it's probably inflation and economic uncertainty.
Okay, Bora. Rustin, good morning again. Let me just go to you with a general question on Russian oil. We have a couple of headlines on our bulletin today. You know, Trump using tariffs on India because of Russian oil. You've got the US saying it won't hit China with tariffs if over Russian oil unless Europe goes first. I mean, the US playing its fun and games with tariffs, but, you know, specifying Russian oil, although it's done nothing really about Russian oil itself effectively, and it wants that oil to keep flowing and hasn't really come down hard on Russia. Do you expect, Rustin, is the market at all feeling that we will see a change in Russian oil flows into those countries that are taking it at the moment?
Well, I don't think we'll see a change in oil flows into those countries. I think India's already been pretty adamant that they're going to retain taking in Russian crude oil. China, with all of their interconnectivity, is still going to take in Russian crude oil. So I don't see much change in that flow. I mean, the big impact to the oil markets in general in relation to Russian oil has been the successful attacks that Ukraine has made on oil infrastructure and refining capacity, which is basically starting to impact the clean products or the refined product space, which is reducing Russian revenues and probably backing crude up into the producer of the crude in Russia. Because Russia has limited export capacity. I think they can get up to about 4.95 million barrels a day, and that's about all they can do. So when you start losing that refining capacity, it's very hard for them to export more oil to the market to generate more revenue for the country. So from the product standpoint, you can see this in the product cracks. I mean, gas oil cracks are rocketing upwards. Fuel oil is a bit weak. Naphtha is a bit flat. But nevertheless, you see it in the distillate side of the curve where Russia is a major exporter of distillate, and with those refining assets being hit, we're seeing less Russian distillate into the marketplace, which is going to impact, a lot of demand profiles going into Q4.
Okay, great. And I mean, we'll talk about Asian refined products later as well, or perhaps Chinese, because that's been also a big question mark. China's telling its refineries to stop producing as much diesel, and there's a bit of a bearish tone there as well. David, I mean, I don't want to sort of emphasize too many Trump headlines. He's just landed in the UK, of course, amid a lot of pomp and ceremony. But I do want to talk about one thing to do with the US and Europe, and that is, Europe's pledge to take all this LNG from America, this commitment, massive commitment, financial commitment, apart from anything else, and people in the market questioning whether Europe has the need or capacity or even finances, indeed, to keep that commitment up. And again, Trump using, the tariff threat, if you like, for that. I mean, how much control do you think Europe has on its sort of energy policy and consumption when it has these trade tariffs to negotiate at the same time? Do you think it's having an impact on that?
Well, I mean, you're right to raise the apparent deal that was done by the EU. The implication being that compared to last year's energy imports from the United States, Europe needs to treble that in monetary terms over the next 3 years. Quite frankly, I don't think that's going to happen. I think it's impossible for that to happen. Governments don't determine purchases of energy. It's commercial concerns largely who do that. So I can't imagine that the European Union is going to mandate uh, private companies to go out and buy more American energy. And the other point is the implication from that deal would be that the US would need to essentially switch most of its hydrocarbon sales towards Europe relative to other regions. So I think this was a nice bit of policy talk. I actually think, rather akin to what we saw in Trump 1, when China signed up to buy multiples of its prevailing amounts of US energy, it'll quietly get forgotten. It is likely that as Europe transitions away from Russian energy, which it wants to do over the next 3 to 4 years, they probably will buy some more, particularly US LNG, a bit more, maybe middle distillates as European refineries close down. But a trebling of imports from the US, I don't see that happening.
Okay, and of course, it all depends on how the Russia angle does actually pan out. No signs that the war is ending anytime soon. But of course, there have been questions about whether Europe would just go back to square one once, and if the Ukraine war ends, and sort of go back to taking the cheaper Russian gas at the end of the day. It's economics. But we wait and see on that. Bora, you were mentioning the gold US dollar correlation earlier, but let's just talk in general about also the liquidity aspect that may feed into oil prices, because obviously we're expecting a Fed rate cut. Others are saying we're going to have more than one this year, and many in the market saying we might see a bit of more of a drop, bearish tone in prices, but ultimately we could go back into the 80s once that extra liquidity goes into economies. Would you agree with that? Could we see, given also the supply fundamentals that we mentioned earlier, could we get back into the 80s for oil in the next 6 months?
Possibility. I wouldn't necessarily
Because of
expect it
liquidity, obviously, because of the liquidity aspect.
I think when you're referring to liquidity, I think the Fed would prefer to not the current Fed, right? The Fed under Chairman Powell, who is being called all types of inappropriate names, from stupid person to knucklehead to incompetent by the president. This current Fed would prefer not to put in that much liquidity to put oil into the 80s.
Yeah, and inflation is still around, it's still rearing its head, isn't it?
And what would a $80 oil do for inflation and the popularity of even Trump? Sometimes you don't know if Trump is really thinking through his asks, if he really wants to get what he asked for, because he said, look, I want to have lower interest rates because the cost of housing is too high, and we got to bring the cost of housing lower. I mean, I'm not sure that lower interest rates would have that effect. I mean, it might bring mortgage payments down.
Yeah.
But again, the value of housing might be even more unaffordable for the Gen Z who can't get on the property ladder. Likewise, if he's thinking more liquidity in the market is going to make people happy, it might lead to the other outcome as you alluded to. If
Were
it's
you
allocated
surprised?
into
Were
the
you
oil sector, $80 oil would severely
Yeah.
pain his core constituency. They wouldn't be happy with that.
Were you surprised by
So,
the jobs numbers that we saw coming out of the US? Last jobs numbers that we saw, and then they were
of
even
course,
revised
I
downwards
was
even more.
a revision of that scope, is putting into question whether the statistics are reliable, whether the statistics are sheltered from political influence. And, I think that's entirely
There's
discounted now. So, we're
a lot of
supposed to,
data questions. Yeah.
I don't like to be such a skeptical person, but you wonder, maybe that jobs number was revised to put pressure on the Fed to bring down the rate.
Yeah,
Or
yeah.
was
You
it the
just
real true statistic? I
we'll
don't
wait and
know.
see what the next one shows. Okay, Rustin, let's talk a bit about geopolitical risk because obviously that's always lingering there, isn't it? We had, the attack on Qatar, of course, last week, and the reaction is still making its way back in the international space, but oil prices didn't seem to, quiver much. Again, I mean, nothing seems to be budging prices from geopolitical risk. I mean, there's an unprecedented event like we saw last week. Has that completely been negated now by the market?
No, I think geopolitical risk is the supportive mechanism that's holding the market where it's at. I mean, you still have a slight backwardation in the front, and that backwardation is justification because of the geopolitical. If you take all the analytical words of how big the overhang is going to be in the near future, if it materializes in the scope that it's going to, yeah, prices should be lower. However, because you have that geopolitical risk in the front of the curve, nobody in their right mind is willing to sell off the front until you actually see that physical manifestation of an overhang develop. So the incident in Qatar, yes, that was kind of I'm going to say a damp squid more than anything else. Nothing really happened after that, and to be quite honest, the meeting in Qatar post factum
Yeah.
was not anything that really pushed the needle one way or another. It was a lot of strong, fist shaking in the air and how dare you, but nothing else has really materialized. I don't think the market is expecting anything to materialize.
Yeah, in terms of
So
any
I think
action.
that's it. It is what it is. It happened, and the sun rose the next day.
Would shippers be any more nervous after last week, having adjusted a lot in the last 2, 3 years their routes anyway? Would that impact, for example, people who are monitoring Suez
Well,
flows?
the war insurance rate on ships has been phenomenal, and it's going to remain because not only did you have you had the 12-day war between Iran, you still have the threat of Iran that poses to shipping going through the Straits of Hormuz that has not diminished. The Red Sea is still an issue with the Houthis, so rates are going to remain the same. I mean, if you're a tanker owner right now, you are living the dream. I mean, freight rates are going through the roof, and they probably will exceed 100,000 a day if we get the materialization of a supply overhang in the market of crude oil. Currently, on the clean fleet, the ships that are operating within the rules and regulations of the world, rates are currently exceeding 80,000 to 90,000 a day for a VLCC, and fairly close for that for a Suezmax. So as long as the market stays where it is and everything moves as it is, it's a great day to be a shipper.
Okay, well, there's our survey question, which addresses the geopolitical risk question that we were talking about. Has that become negligible? I mean, Rustin's saying it's there as a support, but it doesn't seem to be shifting much up or down with the market. Is the market blasé on sanctions now and/or escalating Gulf tensions? David, talking about the Gulf, just to touch on Iranian oil, I mean, not that that's a specialty of yours, but I just wanted to have an idea of what feedback you're getting from the market. Again, it's been a bit quiet regarding Iran since June, the fun and games in June. And Iranian oil exports actually were doing quite well, relatively speaking, this year. They were kind of inching up in the last 12 months. And despite the threat of snapback sanctions and all that maybe kicking in, any evidence there on the water and intake from countries like China that might be shifting?
I think we're seeing a little bit of a downturn at the margin in Iranian exports, but it's not been very dramatic. The flow is continuing. Some of the ship-to-ship transfers that were taking place offshore Malaysia, some of that trade has moved to Indonesia. That's a slightly higher cost option. So from a cost standpoint, there may be a little bit of reticence by some Chinese refiners if those barrels become too costly. There is other heavily discounted crude there on the market. So I think we'll see month-to-month shifts in offtake of Iranian barrels, but we're not really getting a perception at the moment that there's a major move away from Iranian crude as things stand at the moment.
Okay, I mean, Bora, just to look at China from that aspect, there was a period earlier this year with the whole tariff back and forth negotiations. The Chinese did tell their refiners to pause taking as much Iranian crude as before, but I think that's kind of, and again, that's why it's sitting offshore Malaysia, etc., for a while. But again, from your perspective, are you tracking that at all, or do you see, especially from a China consumption point of view, any changes?
I'm not tracking it closely. I think China is not going to be compliant with directives from Washington, but clearly, so they're internationally facing shipping groups, banks, etc., will
Secondary
abide by
sanctions, yeah.
whatever regulations they are subject to. But a huge part of the Chinese economy is insulated from those type of interconnections to the dollar economy. So they have the strategic autonomy um, to acquire energy resources from whichever source they
Okay.
see fit. Yes, there are institutions that will abide by U.S. policies. Those are the ones, the institutions that you would see in London and throughout the Western world. But they clearly have a whole parallel infrastructure for procuring energy supplies, which
Okay.
is completely insulated from.
Let me ask you, Bora, just let's switch to the other side of the globe, the US. If you've got an update any at all on US oil production. I mean, we've had, it did hit 2 years ago, I'd say, two in 2023, and that hit a sort of unexpected high, a higher than expected production. It's kind of calmed down a bit there. What's the sentiment around current oil prices supporting continued sort of US production as it is, static, or would you see that becoming more vulnerable if we see a further drop in prices?
Really, I haven't been following U.S. Statistics and investment dynamics. I should be, but I did notice the gas tech
Okay.
announcements by the U.S. Energy Secretary claiming that they're going to double LNG exports, or
Yeah.
even more than that.
Well,
So
that's
those
been
are
the
incredible claims that require investment, and I do see investment decisions being taken into the LNG sector, but doubling, that's a lot to ask for. So I would wish him luck that the capital is there, and that the investment cases are solid.
Okay. Rustin, we mentioned OPEC earlier, OPEC sort of revising and adding more oil as of October, that's the plan, into the market. What about non-OPEC country production, including the US obviously, but other non-OPEC supply? Is that lingering as a supply concern, oversupply concern, adding to that in the market, or is it really the primary other
Well,
producers within OPEC
It,
plus?
it is adding to it because you have new fields off Brazil and Guiana that are producing more, adding more volume to the marketplace. There's been a couple of big discoveries off Angola as well over the last 6 months that are very commercially viable. So the non-OPEC nations are adding more volume to the market, which is adding to the overhang. So now it's just a question of when does that overhang actually materialize and how hard OPEC's going to fight for market share. It seems like with the OSPs out for the last tranche,
Yeah.
Saudi Arabia is definitely looking to get back market share from Russia as other people into Asia. And so if that's the case, we could see a protracted price war develop going into Q4.
Okay,
OPEC
interesting.
leading
Yeah.
the charge.
Yeah, David, would you agree with that? That OPEC's policy all year really has been to slowly, incrementally take back some of its market share, let prices drop a little bit. It puts it in a stronger position than other producers with lower prices. Would you say that has become now a bit of a priority for OPEC and the primary members of OPEC, the large, Saudi, UAE, etc., Kuwait, Iraq?
Well, I think the core Middle East producers this year they have at least stopped losing market share in China and India, for example. There's an interesting dynamic at work that over the last 3 years, for obvious reasons, the core Middle East producers have lost market share to Russia in India and China. This year, they've managed to sort of put a floor under their share of that market, and they're gradually increasing production. As I say, since the spring, exports have actually not gone up very much from the core Middle Eastern producers, but we should start to see that happening in the fourth quarter and into the first quarter of next year. So, is it about market share? Is it also the Saudis and the other core Middle Eastern producers saying to other OPEC Plus members, show us what you've got? Because we know that the sort of next production agreement for 26, 27 is going to partly be based on perceptions of production capacity. So there may be a sense of, yes, putting a floor under the loss of market share in Asia and reclaiming some of that, but also saying to some of the smaller OPEC Plus producers, okay, if you want a better quota for 2027, show us what you can do now. So I think it's a twofold process, really.
Yeah, there has been some questions over capacity, basically, and obviously, it's just only a few members there who can at least very quickly bring on what might be needed, or even withdraw that in turn. Rustin, let's just, you're based sitting in Europe, and just have a kind of switch the conversation a bit to where the energy transition sort of story is lying. All this talk about energy security and supplies and geopolitical risk and the whole focus in Russia-Ukraine war, the focus has really, gone off, if you like. The pressure on that pedal of energy transition in Europe has been diverted a little bit. Would you agree with that? And where, with Europe, with all its other economic problems and priorities, where does the energy transition story stand?
Well, I don't think the energy transition story has been, it's been derailed. It has been shifted a bit to becoming more of an energy security narrative, because it is a case of, what do you do if your best friend next door decides to shut off your tap? You have to have your own energy security, and I think that's the focus that's becoming. So it still promotes transitional energy systems, i.e., wind, solar, geothermal, what have you, to diversify the energy mix within the EU in order to ensure that you're not reliant on one total energy source to supply all your power needs. I mean, it's pretty interesting that nuclear has now come back into the discussion point, and it's actually been given green credentials by the EU. LNG has been given green credential by the EU as well. So you're starting to see a more, I'm going to say, more rational approach to energy transition than what we had before, where it had to be green or nothing. Now it's like, let's figure out the right way to make it happen so we don't impact our economies even further by going too far down one path. And let's keep the diverse portfolio that we currently have as long as possible until you get the economies of scale around some of the more cleaner energy sources, or if you can even bring back more nuclear, and therefore you're no longer relying on carbon fuels to generate a lot of your power and a lot of your energy. So I think the transition is still there. You still see people buying EVs. EV sales are still doing pretty well. The EU is worried about China's push of EVs into the EU. So they are putting more tariff controls on Chinese products, even talking about price controls on Chinese cars as well, to allow the European car makers to have a space in the EV sector.
If they can compete on cost. I mean, I hear in the Gulf, I mean, the Chinese cars are absolutely everywhere now, and not just hybrid or EVs, but just even other motor ICE, not ICE, yes, internal combustion engine cars as well. Bora, let me go to you to close up for us there on China and sort of electrification, the journey that it's making to energy independence through its transition policies as well. We've seen diesel and gasoline, demand a plateau, etc. Huge amount of focus also on trying to transition slowly but surely. The word being transition, right? It's not overnight. Do you expect that agenda to continue? China has its own economic challenges ahead.
Clearly, I think looking at China, you talk to people there, and clearly they see that real estate, that's not going to be a sector where they're going to be creating more capacity, but everything else is becoming electrified, and it's amazing. You look around there, you see more than half the cars are electric. Most of them are brands that you've never heard of, not just BYD and a few others
Yeah,
that
yeah.
we see in showrooms here, but all types of, and they're very nice. If you actually go to the car dealership and sit in the cars, they're very comfortable, and they have all the sort of entertainment options and plush seats that we're used to, depending on your budget, of course. So I see that
What
disseminating
about
throughout
solar
the
power?
global
What about the
economy.
solar power sort of journey?
And solar is, I think, a big focus of their electrification efforts, given the investment they're putting into their own grid, um, power transmission technologies, power control, substations, all that. There's a lot of investment going into that, and batteries, grid scale batteries. We see that in Europe as well. To be fair, there's a major focus on soaking up the surplus when the wind is blowing in the middle of the night, or on the hot sunny days in the Mediterranean, to give that power back to the grid through the battery when the demand is there.
Yeah,
Trying to,
the intermittency
because that
issue.
was the
Yeah,
main objection to renewables, was that it doesn't correlate to customer demand. But I think with the
yeah.
battery technologies coming out of China, with the Europeans rushing to catch up behind them. To be fair, there's a fair enough competition there. I think both solar, um, especially solar, um, will continue to be quite compelling.
Okay, fantastic.
But
Thanks so
but
much,
I think
Bora. Thank you.
the main
Yeah.
focus we have to put on is this sort of, if I may, um, the competition between these blocks, U.S., Europe, and China. And what Europe is not doing is getting the energy at the price they need to keep their industries competitive. Hence, we see the German job cut announcements in
Yeah.
steel, in automotive, in petrochemicals. This is getting really painful. So yes, security of supply is one thing. The Russians shouldn't shut off our gas, but the Russians didn't shut off your gas.
No, no.
Somebody else blew up Nord
Somebody else
Stream,
did. Yeah.
and you sanctioned them. So that makes a big impact on your competitiveness.
Yeah, that affordability obviously is key, isn't it? Thank you so much, Bora, and to David also and Rustin for joining us this morning. Great to have everybody with us. We have our halftime talk weekly interview playing in an hour with Frédéric Lasserre. Many of you, I'm sure, would know him from the Gunvor Group. Again, giving us their point of view on the markets and where those are going. China stockpiling, obviously one key factor to watch going forward. Thanks so much, everyone, for joining us, and have a great day.
Thank you.
All the best.
Bye.
Thank you. Thank you.